Welcome, everybody. Thank you so much for joining me today. My name is Kelly Catalinas. I am a branch manager with Fairway Independent Mortgage, and I am based out of Fairfax, Virginia. Today, we're going to discuss the path to home ownership and how it starts with us here at Fairway. So we'll walk you through several slides today. We'll go into some detail regarding the whole home buying process, and we'll jump right in here and get started. So just a little bit about me. Again, my name is Kelly Catalinas. I am a branch manager with Fairway Independent Mortgage. A little bit about me. I have been a branch manager and loan originator here in the Washington, D.C. metro area for over 30 years. I have managed large and small sales teams. Over that timetable, I have opened and managed 3 joint mortgage ventures with real estate companies and builders. I am a mortgage professional training specialist in mortgage financing as well as high performance sales. And again, over the long career, have won various awards. Most recently, the Washingtonian Top Mortgage Professional here in 2021. Very proud of that one. So we'll go on to the next slides and get right into it here. So a little bit about Fairway. This just lets you know who we are. We've been in business over 20 years since 1986, actually, so 25 years this year. And I'm sorry, that's 35 years as of this year. And we are licensed in all 50 states. Hang on, I got to back up. We have been in business since 1996, not 86. So let me back up here. I'm starting over, Fraser. Hi there, it's Kelly Catalinas with Fairway Independent Mortgage. I am a branch manager with Fairway Independent here in Fairfax, Virginia. And today we're going to talk about the path to home ownership. And we'll jump right in it here and get started. A little bit about me. As I mentioned, I am a branch manager with Fairway Independent Mortgage. And I have been an originator and branch manager for over 30 years in the Washington, D.C. metropolitan area. And you can see I've opened and managed several joint ventures within the real estate community and builders. And I am also a training specialist in mortgage financing and high performance sales. Received various Leaders Clubs awards, and most recently the Top Mortgage Professional Award from the Washingtonian this year. So let's get started. A little bit about Fairway. We have been in business since 1996. We are licensed in all 50 states. And this slide just kind of gives you a little bit about Fairway and some of the accolades that we have received over the course of the last few years. Our commitment, right? Purchasing your first home definitely is an exciting time. It can also be very stressful, and we recognize that. We are really trying to take the stress out of the loan process and walk you through the entire process each step of the way. We really try to work quickly. We try to work in advance of you finding the property of choice, and we want you to be comfortable and waiting for your loan to close, not worried about your loan to close. Some of our core values here that define who we are, how we interact with each other, and how we can best serve our customers and our team members, as well as our real estate community. Top 10 core values. Number 1, humility first. We are committed to serve the community that we work in. And you can see speed to respond, seek wise counsel. We are a person first company. We are a customer first company. And we really try to make the experience very satisfying for all of our prospective purchasers and our real estate partners. So let's talk about renting versus owning, right? Usually when you embark upon trying to purchase your first home, you might be a renter or you might be living with family members, etc. But rent adds up over time, right? So here's just a brief chart that demonstrates how much your rent payments could add up over the years, which is money that obviously you could be investing in the home of your dreams or your starter home. It could be your first home or a stepping stone home till you get to the home of your dreams. So you can basically see how if your rent is $900 a month up to $2,400 a month, well, after 2 years, how much money you've spent with nothing to show for it other than living in that location. After 5 years, after 10 years, and after 15 years, it is quite a bit of money that you've set aside for the privilege of having a mailing address versus having any equity growth or ownership in the dwelling in which you're staying. So, like I just mentioned, renting earns you nothing, right? Investing your money into a mortgage helps you build equity and wealth. So 10 years of $1,000 a month in rent equals 120,000, and an estimated zero proceeds when you move out of that property. 10 years of $1,000 a month in a mortgage equals 120,000, and an estimated $50,000 perhaps in home equity that you would take with you as you go search for the next home when this home is sold. So owning a home is an easy way to help build wealth and money over the course of time. So why rent when you can own, right? We all ask ourselves that question when we're trying to take the leap into home ownership. Are you renting because you think you can't afford to buy a home? Okay. Your monthly mortgage payment could be less than your monthly rent. With rates at historic lows over the last few years, it's the perfect time to consider the difference between renting and home ownership to see if the same money can stretch you into that home that you're looking to purchase. So $1,000 and $1,050 a month may be able to buy you a $155,000 home. $1,900 a month may be able to purchase you a $280,000 home, and so on and so forth as we move up. So again, the benefits of home ownership, right? Financial health and wealth, part of your wealth strategy. I know when you start your jobs, a lot of times you might be seeking out a 401k or something to put away for your retirement. Well, purchasing a home is part of that same package of building wealth over time. You want to create equity in your home. You want to have the possibility of qualifying for federal tax deductions because of mortgage interest deduction availability, and the ability to increase your home's value with renovation or upgrades that you choose to make over time. And again, achieving the American dream of home ownership, right? We are not tax professionals at our mortgage company. We do advise you to seek a tax professional about the benefits of home ownership should you want to pursue that. So when you're speaking to mortgage lenders and you're trying to get into the process, right? A lot of times we might get a call from prospective purchasers and they might say, what is the interest rate? What are the closing costs? And while those are good questions, they might not be the right questions to start with, right? We as lenders really want to try to work with clients to find the best possible financial solution for what their goals are with home ownership. Some better questions might be, well, what am I trying to accomplish with my housing situation? Is this my dream home? Is this my starter home? Is this, just don't want to pay rent anymore. I just want to get into something that I can own now and then at some point sell and move into something else. Why is it better to buy a home right now versus renting a home? How can I make sure this fits into my short-term and long-term budget? That's what we can help show you some of the options. How will this financial decision impact other areas of my life, right? You need to think about the obligation of paying on a home mortgage if you're saving for a wedding or a child's college fund or care of an elderly parent. Is that going to fit within the budgets for your particular lifestyle or demands on your monthly budget? What mortgage and home buying strategy will result in less overall financial risk? And those are some of the things that we can help walk you through once we speak with you and go through some of your financial situation, as well as your goals for home ownership. So again, there's always risks when you do anything. When you make any decision, there's an opportunity cost or a risk involved. So you could be concerned that the house value may decrease. You could be concerned of house value increases, although usually you're not that concerned about it increasing in value, but only if it doesn't increase enough. And for an example, let's say you were purchasing a property in the short term and you knew you had to leave in 3 years, let's say. Well, if the home value didn't increase enough, you're going to be concerned about the next bullet point, the high cost of selling the home, where you may not have built enough equity in the property to pay for those costs of selling it, real estate commissions, getting the house ready for sale, etc. So it works both ways. House value decreases or increases depending upon your circumstances. Maintenance costs of home ownership. Is it a newer home? Is it an older home? Is there deferred maintenance? Do I have a 25-year-old HVAC air conditioning system that might need to be replaced, or is the roof 25 years old, etc.? The opportunity cost of using the money some other way, instead of putting it into a down payment or closing costs on the home. Maybe concerns over a lack of liquidity, right? You've saved all of this money, you've set it aside, now you want to use it to purchase a home, and you're giving up that liquidity or that savings. And the long-term commitment and changing cash flow needs that might come down the line. So it's a long-term commitment on the mortgage, but maybe you're looking at private school for your children, or college tuitions, or things that are going to take money out of a budget. Your concern might not increase enough for what you need to do with your family down the line. So we have disadvantages and advantages with homeownership. Disadvantages, yes, you're responsible for property taxes, maintenance and repairs. Monthly housing costs might cost more than you're paying in rent. Your cash is tied up. You can't always sell a home quickly depending upon what market you're in. Less mobility than renting, right? Because you have to sell the home if you want to move out of it or rent it out or something. And a decline in equity. What happens if there is a correction in the market and homes are devalued for some reason? But you also have great advantage for home ownership, which could outweigh some of the disadvantages. Definitely seek tax advice for tax benefits, greater stability of lifestyle, neighborhood, etc. It could be a great investment. If you look at historical data in the neighborhoods that you're considering, you might see that there could be an average rate of home appreciation growth that you could expect. That may do better than if you had taken that money and placed it into a monetary fund, hoping it would achieve the same outcome. Your first home may lead to a better home. So you could have equity from the first home built so that it enables you to move to the next home more easily. And again, pride in home ownership. There's no doubt that more homeowners create more community and solidifies that community versus, just a lot of renters going in and out of that particular community. So stability is a big one there. So the 5 biggest myths that prevent people from buying a home. One, you need perfect credit. Absolutely not true. There's plenty of loan programs out there for people who have had credit challenges in the past. I need 20% down payment. Again, also not true. There are some loan programs with no down payment, some loan programs with 3 to 3.5% down payment, etc. And we can all look at that once we look at your particular situation. I won't qualify. You need to leave that to the professionals to tell you whether or not you will qualify. Listen to us, not all the whispers of friends around the water cooler that may not know exactly what your situation entails. I can't afford the monthly payment increase. Well, that might be a tax accountant or tax professional question. When they talk to you about the tax advantages of home ownership, it might end up being less than what you're currently paying because of that tax advantage. And home repairs are too expensive. Always a concern for anyone, but you'd also have concerns in a rental scenario, depending upon the nature of damages or concerns that way with any rental property as well. Things to know, again, before you buy, you definitely want to speak to a lender so you can find out early how much home you can afford, okay? That's an easy conversation with a lender that they can walk through several questions with you so we can establish an acceptable loan range that works for you. How much of a down payment can you afford? Again, we'll go through a series of questions to see what you might have available to use for the home purchase. Will I be able to make the monthly mortgage payments? Well, we're going to show you what we would tell you the monthly mortgage payments are that we think you can afford, and then you can decide if that's agreeable to you, or if not, we can go backwards from that. We can reduce it and see what size home a lesser monthly payment could afford if that makes you feel more comfortable. We definitely want to ask you how long you plan on owning this home for, because that will give us some structure and guidance in looking at various loan programs for you that might fit a shorter term than some longer term instruments. And are there additional costs to owning the home that you should consider? Always you want to know about additional costs such as homeowners insurance, real estate property taxes. If you're putting less than 20% down, there's private mortgage insurance that might be involved in some cases. Are there homeowners association fees in the neighborhood that you're looking at for maintenance of streets and snow removal and tot lots and things like that that are applicable in those neighborhoods? So you definitely want to ask those questions early on as you're letting us know what kind of property and what neighborhood you might be interested in pursuing. So how much home can you afford? Here are the factors that we look at in determining how much you can afford. We do look at the debt to income ratio, and that is the calculation of your total monthly debt obligations over your gross monthly income. We look at the assets you have available, your minimum payments on any debt that you currently carry and how long you might be paying on those for, the credit ratings and the use of credit history, as well as affordability. You know, what are you comfortable with paying, and does that payment allow you to buy something that meets your needs for you and your family? So what is a credit score? This is a question regardless of if you're a first-time home buyer, a move-up buyer, or a very seasoned homeowner and you're looking to purchase more property. Everyone is always very concerned about what a credit score is. So defined, it is a numerical representation of your statistical likelihood to repay the credit that is extended to you. So there's a lot of formulas that go into calculating your credit score, but it is a snapshot of a specific moment in time when your lender pulls the credit report and can tell and will change with the new actions in the passage of time. So here you can see all the way across the board what we consider good credit scores. And when we run a credit report for you, if you are interested in purchasing a property, it is something called a tri-merge standard factual report. It is not Credit Karma. It is not something online that just says, hey, your credit score is a bazillion high. It is a standard factual credit report, and we pull from Experian, TransUnion, and Equifax as the credit repositories, okay? The middle score of the three scores is the score for the file. So you can look at the ranges here. If it's a credit score of 8 to 850, it's an excellent score. Very good is 750 to 799. Good is 7 to 749. Fair, 650 to 699. Poor, 600 to 649. And anything below 600 is a challenge for lenders to provide credit solutions for. Ideally, we would like to see that credit score move above 600 to look at some available programs for you. Here's the credit breakdown, and we're going to look mostly at the pie here on the side. You can see it's the amount that you owe is 30% of the score. The credit length, how long you have a credit history, is 15%. New credit is 10%. Credit types are 10% of the weighting, and the payment history is the largest component at 35%. Payment history at 35%, we're looking for on time versus late payments, length of credit history, severity and quantity of delinquencies. Amount owed, too many credit cards with balances can lower a score. Length of credit history at 15% weighting, the longer the history, the better. How long have you had your credit cards or credit accounts been established, and how long has it been since you used certain accounts, okay? New credit, research shows that opening several credit accounts in a very short period of time is a greater risk. especially for people who do not have a long and established credit history. So you don't want to run out and get a cell phone and then apply for a rental history and then buy a new car and get a new credit card. All of those things, let's say within a 2-week or 30-day window, because they're all types of different types of debt, could adversely impact your credit score. And types of credit in use or healthy mix equals 10%. So here are some examples of the ideal credit mix. 2 installment loans, maybe 3 revolving accounts with balances on revolving debt below 30% of the high credit amount, no collections, no public records, no foreclosures, no late payments. Lenders in general will tell you, try to keep 3 to 4 open pieces of credit available at all times. Don't close your old accounts, those long-standing accounts, those credit cards you've had for 10 or 15 years. Use them and then pay them off. Use them and pay them off. We see a lot of people trying to move debt to new cards, and then they close these long-standing histories that they had with these companies, and could be detrimental to your scoring. So try to keep 3 to 4 pieces of credit open and available, pay them off, use them, pay them off, and just keep them active so we get accurate scoring for you. You definitely want to monitor your credit. You want to pay your bills on time or early. You can get a free credit report each year by going to www.annualcreditreport.com. So you could at least see that from the 3 major bureaus each year. Don't co-sign loans because it does impact your credit report as well. Don't close old revolving accounts that are no longer in use. Try to use them, even if it's once or twice a year, pay them off, keep them open. Don't open new accounts unless absolutely necessary to do so. And definitely report fraud immediately to the bureaus. If you are a victim of fraud, you definitely want to report that, possibly put a fraud alert on your credit report so that you're protected in terms of your identity. And do not extend or open new credit accounts while in the mortgage process. Whether you're purchasing or refinancing a home, it can greatly impact your credit scores. Prior to closing, we do a soft pull on your credit report within 7 days of the settlement date to be sure no new debts have resulted and everything is as it was when we first started the loan application. So, we want to maintain good and accurate credit scores throughout the loan process. 5 credit myths. Paying off and closing out a credit card will increase your score, not necessarily if it's a long-standing account with a great credit history. Reducing your credit access could actually hurt a little bit. Excuse me. Paying a collection will raise the score immediately, not immediately. If you're disputing a collection, you may want to leave it and see if the underwriter requires you to pay it. But if you do go in and you decide to pay your collection off, usually every 90 days, the credit report gets updated, and you may see over time that the credit scores will begin to rise. But if you're in the middle of the mortgage process, you might leave it alone, let it go into underwriting, see what they say, and then address the collection at that time. Paying off an auto loan or student loan will improve your score. Again, not necessarily. If you have good credit and have been managing your credit effectively, paying it off doesn't necessarily mean it's going to help the score because you've already proven that you've shown you can manage the debt. Opening a new account will hurt your score. Again, it's not necessarily. It just really depends on what the credit history looks like and how many new accounts were opened within a specific length of time prior to us running the credit report. And having too much credit available hurts your score. Again, not necessarily. I one time had someone who had close to 20 pages of credit over their long careers, and they were managing it. So having that much credit didn't hurt them because they made their payments on time. It really just depends on how you're managing your credit as to whether or not it impacts you or not. So what is a mortgage, right? So a mortgage consists of several components in the monthly payment. You have the principal amount, which is the original amount borrowed, repaid on a monthly basis. That is your loan amount, okay? Your principal amount of the loan. Interest is the cost associated with borrowing that money over time, repaid on a monthly basis. Taxes are typically your real estate property taxes to your county or city government and agencies. And insurance is your homeowner's insurance component for the home that you're purchasing. So what's equity? Okay, when we talk about equity and the goal of building equity with home ownership, well, in real estate, the difference between the property's current fair market value and the amount still owed on the owner's mortgage is defined as equity in the property. It's the amount that the owner would receive after selling the property, paying off any liens, any real estate commissions, anything owed, and is referred to as the real property value of that property. So the housing expense ratio really is what lenders look at when we seek to qualify you for a home loan. We're trying to see how much out of your gross monthly earnings is being budgeted to pay your housing expenses each month. So it is a percentage of that gross monthly income. And what is a loan to value percentage? So when we talk about down payment, when we talk about how much monies you may have set aside for the home purchase, we're really trying to see what the loan to value is going to be. If the sales price was $100,000 and you said, I have 5% to put down, which would be $5,000, the loan amount would be $95,000. So that loan to value percentage is 95%. In the example here, if you had a $100,000 home with an $80,000 mortgage, it has a loan to value ratio of 80%. So it is the relationship between the principal balance of the mortgage and the appraised value or sales price, whichever is lower, of the property. So we get this question all the time. What is private mortgage insurance? So private mortgage insurance is mortgage insurance provided by a company to protect lenders against loss if a borrower defaults on that mortgage. It is not homeowners insurance so that if you have a fire on your property, it gets paid through this policy. This particular policy is designed to help people with lower down payments achieve home ownership. So private mortgage insurance insures the lender against risk of default. It is a monthly expense, or there's various ways you can pay private mortgage insurance, but it does allow you to purchase a property without having to put 20% down. We get this question all the time. What are points? And in lender ease or language, a point is equal to 1% of the principal amount of your mortgage. And it's just another way of saying we are collecting interest today for you to buy a particular interest rate over time. So they're typically collected at closing, and they can be paid by the borrower or the seller, or could be split between them. And for example, if you get a mortgage of $165,000, 1 point means you're paying $1,650 to the lender. Well, let's talk about that a little bit in terms of interest rates. If the going rate today, for example, was 3% at 0 points, then perhaps the going rate today at 1 point might be 2.75%. So you're paying that interest today to buy a cheaper interest rate over time. So lenders will often talk about points, but the value of a point is 1% of the loan amount you're seeking. So what is amortization? People are always asking, how do these payments play out over the course of time? Well, it's a repayment of your mortgage loan with regularly scheduled payments of both principal and interest. And your amortization term is the length of time required to amortize the mortgage loan, expressed as a number of months. And you can go to any number of sites and look at amortization schedules. At the chart on the left, you can see the term of the loan goes across the top. Is it 10-year loan, 15-year loan, 20-year loan, 25, 30, or 40? And then the interest rates would go down the column on the far left. And you can just see factors. Well, those factors are equal to every $1,000 of loan that you have as it equates to a mortgage payment, okay? So let's jump into qualifying for a mortgage. And there are six major factors that we look at when we review your loan application. Here they are. We first look at income, okay? We are looking at gross monthly income, not net income. So if you are self-employed, and we need to look at your tax returns in order to establish what your qualifying income is, be prepared to present those documents to us. We look at your monthly debts. We will pull a credit report. We will see what the debts look like, and we will ask you if there are any debts associated to you that are not reflected on the credit report. We look at the credit in and of itself, the credit history, the credit scores. We look at your employment history, typically covering the most recent 2 years. We look at the property that you're looking for. What type of property is it? Is it a condo? Is it a townhome? Is it a single family detached home? We look at the down payment, closing costs, prepaids, and cash reserves. So we're basically considering the monies available for the home purchase that can be used to meet the down payment requirements, the closing cost requirements, the prepaids, which are your taxes and insurance components that you might have to spend, appraisal fees, etc., and cash reserves. You know, we don't want to take your very last dollar with you purchasing a property. You know, do we have some reserves left after closing, so that in the event of an emergency, you have access to those funds? So let's talk about the process, and we'll go through this pretty quickly, and I'll talk a little bit all the steps. First, we have the initial consultation, and a lot of times this could be you speaking to your realtor, it could be you speaking to your lender. I encourage you to reach out to a lender for step one and step two. Typically, this is a conversation that we have with you when you're interested in purchasing a property. We're trying to define what your goals are. We're going to ask you if there's a sales price range that you have in mind. We're going to ask you if there's monies you've set aside for the home purchase. We're going to ask if you have an idea of what your credit scores might be and how long you might be in this property. This is a conversation. It's kind of on a yellow pad of paper. We're coming up with a loan range for you. It's a basic conversation about what we feel you might be eligible to purchase, okay? Pre-qualification / pre-approval means taking it a little bit further than that, okay? We're going to collect documentation. We're going to ask you to do an application, and we're going to move that file forward to step 3, 4, and then ultimately 5 and 6. Processing, underwriting, pre-closing, and closing. So let's get into some of these steps a little bit more. The initial conversation, as I said, we're going to ask how long you plan on being there, monies you have for down payment and closing, and generally speaking, what kind of monthly payments you might feel comfortable with. We're going to talk about the pre-qualification and pre-approval process. We want to be able to give you as much leverage as possible when purchasing a property. We are going to advocate that you complete an application, that you let us run the credit report, that we collect your W-2s, your pay stubs, your tax returns, your bank statements. Let's validate as much as we can in advance of you locating that property of choice. And once we have that, we can then move your file into processing for full review and validation. So here's a bit of a checklist. I'm not going to go through everything with you, as each person is very unique in terms of the type of documentation that we might require. But generally speaking, we're going to be looking at W-2s and pay stubs and bank statements, and we're going to cover employment history for 2 years. We might ask for other individual things such as signed tax returns and 401k statements, etc. But your lender will definitely go through, evaluate your specific situation and fine-tune this list for you. Again, another pre-qualification checklist. If you're a veteran, we have additional things that we might need if you're a veteran using the VA loan program. If you're divorced or you have separate maintenance agreements or things like that that you're obligated on, that might be additional documentation that we need for the file as well, to be sure that we're either approving any debts that you're required to pay, or if there's income that you're receiving, we would want to prove that income if you wanted to use that in your qualification. The next step is processing. So once we've gathered all of your supporting documentation, we have structured the loan according to what you feel comfortable with, we've set up a hypothetical sales price and loan amount, we are basically moving your application to your loan processor. They will review the file, and once you have a ratified sales contract, they'll order the property appraisal. They may ask for additional documentation or updates that are needed for the file. There could be something that came up once they reviewed it. And then once it's completed, they will move that file forward to an actual underwriter who would be the one to make the credit decision on the loan and issue the firm mortgage commitment. So the underwriter reviews the file to ensure all the guidelines are met for the specific loan program that you're seeking. They issue the loan decision. And once that mortgage has been approved and all of the conditions have been cleared, you will now have your file cleared to close, and it will move now to the closing department for document preparation for signing and closing on your new home. So pre-closing, we send you the commitment letter, you review your commitment, you sign it, we work with your settlement company to prepare final figures, everything is cleared for closing, and the settlement company now can conduct your closing. You'll sign a lot of final documents, and you definitely want to be prepared for your closing day, a very exciting day for everyone. You definitely want to bring your photo ID with you. And if you are bringing monies to settlement, you want to be speaking with the settlement company or attorney as to how to prepare those funds. Are you going to be wiring money into their account? Are you going to the bank to prepare a cashier's or certified check payable to them for the remaining down payment and closing costs due at the loan settlement? Congratulations, you're now a homeowner. Always our goal to walk you through the process from the initial consultation to application, to processing, to underwriting, to the preliminary closing figures, and then the last step is closing, and you now get the keys to your brand new home. This particular slide, I think, is a wonderful slide. It gives you an idea of how the process works and kind of what we went through in this presentation. You start on the left with your pre-qualification. You want to have an idea of what you can qualify for. You might meet with your real estate agent while applying for your loan to get pre-approved and get it into underwriting and processing. You're going to negotiate a purchase price. Once you find a property, you work with your real estate agent on that. You'll provide a deposit for the transaction as part of your offer. You will then get your loan disclosures that are specific to the property that you are purchasing. We'll order the property appraisal. We'll send the loan back to underwriting for final loan approval. And then once everything is approved and cleared, we will send the closing disclosure out to you that will detail all of the costs associated with purchasing the property. You'll have your closing documents at settlement with your title company or settlement attorney. You would have prepared your money for closing and bringing that with you the day of or the day before closing. And then your final closing step is to sign everything. And once the loan gets recorded, the loan is funded by us and you are now a homeowner. So just a couple of things I want to finish up with. Some do's and don'ts when applying for a mortgage. So definitely do's, right? Keep originals or be able to access your employer or bank websites for pay stubs, bank statements, and other important financial documents. Provide your earnest money deposit from your own personal bank account or acceptable gift funds. Everything needs to be verified during the mortgage process. So if you are receiving gift funds from a relative, please let your loan officer know that early and in advance, because there are very definite strategies that we want to follow if you're receiving gift funds that could be easier for you and your family if you're receiving the gift. You definitely want to notify your loan officer if you're getting the gift funds, because certain criteria do have to be met as to who can provide them, how can they be provided, and how we would document that. You do want to let us know of any employment changes, such as a recent raise or promotion or transfer or change of pay status. Please don't quit your job during the mortgage process. I did have that happen to me last year, where we got all the way through the mortgage process and they decided to quit their job and neglected to tell the mortgage company that they were no longer working. And we found out the day before closing that they were no longer working. So we could not close that loan. Be aware that a new credit report could be pulled just prior to closing, and we will do that within 7 days of closing to be sure no major credit score changes, which could impact your interest rates, or that you haven't opened any additional debts during the loan process. Don't close or open any asset accounts or transfer funds between accounts without talking to your loan officer, only because proper documentation could be required, and we want to be sure that you maintain that documentation. Don't deposit any monies outside of your automated payroll deposits, particularly cash or sale of personal property, without notifying the loan officer. We have to track all the monies for home ownership. You can't just have cash show up in a bank account, because the loan officer will say, well, did you go and cash advance a credit card? Did you take money that was cash in your home and now just take it to the bank to deposit it? It may be excluded as an acceptable source of assets. So you definitely want to think about where the cash is coming from for the transaction and be open and honest with your loan officer about that. Don't change jobs or employers without inquiring about the impact that could have toward the loan process. Don't make major purchases prior to or during the contract, such as a new car, furniture, appliances. I know you're eager to furnish your new home. You don't own it yet. Let's just wait until you own it, because we don't want to impact that credit score or your ability to qualify for the home loan because you're taking on additional debt. Don't open or increase any liabilities, including credit cards, student loans, or other lines of credit during the loan process. I'm just going to briefly talk about different types of mortgages here. Again, I think this is a one-on-one conversation that you would have with your loan officer at the time you're looking at various loan programs. We offer things such as fixed rate mortgages as well as adjustable rate mortgages. And the difference between the two is the fixed rate mortgage is level over a period of time. Adjustable rate mortgages could be level for a very short period of time and then start adjusting annually for the remainder of the term. And again, I'm not going to go into too much detail here on these two types of mortgage. I think it's very specific to what you're eligible for. And do ask your loan officer at the time you're ready to do a home loan what you might be interested in, how long you might be in the home, and then we can show you very specifically those things that might work for your particular situation. Various loan programs, I'm just going to do a highlight here. Conventional mortgages, you probably will hear terms such as Fannie Mae and Freddie Mac. For conventional mortgages, highlights are lower interest rates, fewer penalties and fees. There are second home purchase options. They're the best kind of options if you have good credit, slightly higher down payment, although there are several conventional options that offer 3% down payments if you qualify and 5% minimum down payments with some flexible terms. So they've really stepped up for the first-time home buyer in the conventional space. FHA is the Federal Housing Authority loan. Low down payment option, typically geared toward first-time home buyer or move-up buyer with limited amount of funds for down payment, 3.5% down payment, flexible income and credit requirements. So if there have been some credit issues in the past, sometimes FHA is the go-to program for that. It's a little bit more forgiving on some of the credit history issues. USDA loan is the rural housing loan. If you're looking out in the country that meets a rural housing definition, there is a product out there that has a zero down payment program, lower credit score requirements and flexible credit underwriting, and it is very specific to designated rural areas. So we have to search availability for this program by address of property. And then the VA loan or Veterans Administration loan, you must be a veteran or have veteran eligibility to use this program. No down payment is required or low down payment, depending upon what type of program you go with. Low income and credit requirements. There is no mortgage insurance on a VA loan. However, there could be a VA funding fee associated with that particular program. And you're either active duty military, a veteran, or a military spouse for eligibility for that program. Again, conventional loan programs, it's not insured or guaranteed by the federal government. As I mentioned, you typically would hear Fannie Mae or Freddie Mac terminology. And as I mentioned before, it's got lower interest rate options for borrowers with good credit, flexible mortgage insurance options. There's a whole slew of mortgage insurance options if you're putting less than 20% down, fewer penalties and fees, flexible loan terms, and there are adjustable rate mortgages, fixed rate mortgages, and jumbo mortgages for those higher sales price ranges that are above the conforming Fannie Mae and Freddie Mac limits. We refer to that as a jumbo mortgage solution. FHA, provided by the Federal Housing Authority, again, can make it easier for you to purchase a home. As I mentioned again, low down payment options, flexible income and credit requirements, fixed rates and adjustable rate mortgages, typically 3.5% down payment. Loans for 1 to 4 unit properties and condos are available as long as the condo is FHA approved. Down payment funds can be a gift from a relative or an employer, and home sellers can pay for some of your closing costs up to 6% of the sales price of the property. The Rural Housing or USDA loan, U.S. Department of Agriculture, provides affordable financing options for properties located in designated small towns, suburbs, and exurbs. Again, it is for a designated rural area. So if you are looking in those areas, reach out to your loan officer. We can use the tools that we have available to us to see if the property is eligible for USDA financing. There are income restrictions for this program. There are loan limit restrictions for the program, but it is a very good low to no down payment program for someone who's looking in those areas. The veteran program, near and dear to my heart. It's backed by the Department of Veteran Affairs, and it provides affordable home financing options for service members, veterans, and surviving spouses. No private mortgage insurance, no prepayment penalties, 100% financing is available with full entitlement. Some of VA's financing fees, such as the funding fee, can be rolled into the loan amount or added to the loan amount as opposed to a cash requirement. And you can use all types of properties, such as single family detached homes, townhomes, and condos, but the condos must be VA approved. And when we talk about loan eligibility, a valid certificate of eligibility, or COE, is based on the length of service or service commitment, duty status, and character of service. We can find and pull your certificate of eligibility. If you are a veteran and you do not know whether or not you're eligible for a VA loan, reach out to your lender. We have access to the VA portal. We'll ask you a few questions and we could try to achieve and pull that certificate for you so we know what we're working with for your VA loan. Some tips for home buying. Keep your credit current. Make all your payments on time. I know that sounds kind of obvious, but make your payments on time. Watch your spending patterns and avoid incurring new debt before applying for a loan and after you've completed the loan application, right? Keep everything steady. We don't want to have any big jumps in spending or incurring new debt. Meet with your loan officer before you begin your home search. It's very challenging to go out there, start looking at properties when you really don't have a good idea of what you might be eligible for. And the last thing you want to be is disappointed in reaching for a property that you may not be able to afford from a qualification standpoint. So definitely a good idea to speak to your loan officer before you start searching for properties. Get pre-qualified before you shop for a home, and do not have anyone except your loan officer run your credit history. You want to limit the amount of touches to your credit report as much as possible so we don't impact the credit scoring for your qualifications. So 7 costly homebuyer mistakes: not getting pre-qualified, lack of organized documentation, can be very frustrating for all parties involved in the transaction. Not consulting with a lender or realtor early in the process. If you have credit concerns or credit issues or concerned about employment or income, get all of that out early before you start searching for a property. you might not be able to purchase a home today, but you may be able to purchase a house 3 months or 6 months from now if we get together and we set up a strategy for home ownership. Not understanding the market, relying on Zillow, Trulia, or Realtor.com. Those are all great starting points to look for properties, kind of see what's out there. But agents and realtors that work in those areas know the market. They know what they're seeing. They have access to great data. So definitely take advantage of your local real estate agent. No buyer agency, no representation for you. Be sure when you're going out looking at homes, you have your realtor that is responsible for your best interests in tow, okay? Or at least you're presenting their card to whomever is showing that property. You want someone with your best interests at heart working for you when it comes to purchasing a property and wandering above the pre-approval limit. So you're approved for 300,000 and you suddenly call me after we've done everything and say, I want to purchase 350. That's a concern because perhaps you might not qualify for 350,000. So we definitely want to look at the highest sales prices you might be looking up to before you start your home search. So let's have that candid conversation as to what's the threshold you might want to be pre-approved up to. You might not be anywhere near where you want to spend, but it's worth it to see if you can get pre-approved for that higher level just in case. We've got a mobile app that we can share with you. Some people would like to have this because it has some great tools as you're out looking for your home. It allows you to do some quick payment calculation. We work with you directly and we'll share this with you if you end up doing an application with us and you want to just apply for your loan via your phone. We have that availability too, but it's a great tool that you can have at your fingertips as you're out looking at properties, running some numbers, trying to look at amortization and calculators and payments, etc. So you can ask us about that as well. Again, selecting the right mortgage for you. When you decide to purchase your first home, please make sure you work with an experienced mortgage and real estate professional. Become educated about the mortgage process like we're doing today, okay? Understand the components of the process, what goes into the process. You don't have to know everything, but we're hoping that you know enough to ask the right questions for your particular circumstance. Know how much home you can reasonably afford. Get pre-qualified. Review a variety of loan programs to make sure you find the best option for you. And we can help with that as a resource for you. If you're someone who's only going to be in the home for 3 years, maybe a fixed rate loan isn't the best option for you versus a shorter term adjustable rate. It depends on the way the loans are priced and what your goals with the property are. Have any additional costs, renovations, or upgrades in mind? So some people immediately want to look to purchase a home and then they turn around and want to renovate it. Well, how does that impact your budget? And is that something you'll be able to do? And definitely have a general idea of how long you plan to stay in the home. One of the biggest questions in trying to select the right mortgage for you is really trying to understand how long you might be in that home and your goals with that property. Again, I want to thank you for attending today. It has been my pleasure to present our home buyer webinar to you, and I thank you for joining us. Please don't hesitate to reach out to me, Kelly Catalinas, with any questions you might have. You can go to my website at www.kellycatalinas.com. Thanks so much. I appreciate your time.